Let's talk about the 1%. Not in the political sense. This video is not going to make you angry about wealth inequality or inspire you to attend a protest. There are other videos for that, and they're probably more entertaining than this one because they involve signs and chanting. This video is going to do something more useful. It's going to explain specifically how the people at the very top of the wealth distribution actually manage their money. The specific structures, strategies, behaviors, and philosophies that keep the wealthy wealthy and make them wealthier. And then it's going to explain how to apply the same principles to a financial life that does not currently include a private equity stake or a family office. Because here's the thing about how the 1% manage their money that most financial content gets wrong. It's not primarily about having more money. It's about having a different relationship with money, a different set of priorities, a different decision-making framework, a different set of professionals advising them, and a specific philosophy about what money is for and how it should be treated. That produces different outcomes at every income level where those principles are applied. The person who inherits the 1% money management philosophy without inheriting their money will out-accumulate the person who inherits the money without the philosophy every single time. This is documented repeatedly in the research on wealth transfer. The specific finding that inherited wealth is dissipated within 3 generations in the majority of cases, because the generation that receives the wealth without having developed the philosophy that generated it reliably fails to preserve it. The philosophy is learnable, the structures are replicable, the behaviors are adoptable, and the professionals, in a modified form appropriate to a non-billionaire's financial situation, are accessible. This video is the transfer of that philosophy without the trust fund that usually comes with it. A few honest acknowledgments before we begin. Some of what the 1% do is genuinely only available at their level of wealth. The family office that manages $500 million in assets is not something you replicate on a $500,000 portfolio. Where those strategies are genuinely inaccessible, this video will say so and describe the closest accessible equivalent rather than pretending the equivalent is identical. The goal is not to pretend that a $5,000 investment account works exactly like a $5 billion endowment. The goal is to identify the principles that operate at the $5 billion level and find the genuine analogs that operate at the $5,000 level. Some of what the 1% do involves legal tax strategies that are significantly more aggressive than what most financial advisors recommend for ordinary clients. Not illegal, but at the edge of what the tax code permits, pursued with teams of specialized professionals whose full-time job is finding and defending those edges. This video will describe those strategies at the principle level, with the honest acknowledgement that accessing them requires professional guidance rather than a YouTube video. And some of what the 1% do is simply behavioral, the specific ways they think about money, time, risk, and professional relationships, that is not only accessible, but is the most directly impactful thing to replicate, because behavior is the variable that most determines wealth outcomes at every income level. Let's start. Chapter 1. The Asset Allocation Philosophy. How the 1% actually invest their money. Here's the first and most foundational difference between how the 1% manage their money and how most people manage theirs. The specific allocation of capital across different asset classes that produces the long-term wealth accumulation and wealth preservation that the 1% achieve with a consistency that most investors don't approach. This difference is not primarily about investment skill. It is not primarily about access to better information or superior market timing. It is about a fundamentally different conception of what a portfolio should contain and why, a conception that produces a different asset allocation at every wealth level, and that the evidence consistently shows is more effective at building and preserving wealth than the conventional portfolio that most retail investors are guided toward. The conventional portfolio versus the 1% portfolio. Here's the specific contrast between the typical retail investor's portfolio allocation and the typical 1% investor's portfolio allocation. Stated plainly, because the contrast is more striking than most people expect. The conventional retail investor's portfolio is heavily concentrated in publicly traded stocks and bonds. The standard financial advisor's recommendation, often some version of 60% stocks and 40% bonds, adjusted for age and risk. Tolerance is almost entirely limited to publicly traded securities. Stocks means publicly listed companies traded on the New York Stock Exchange or NASDAQ. Bonds means U.S. Treasury bonds, investment-grade corporate bonds, or bond mutual funds. The alternative asset allocation, real estate beyond the primary residence, private equity, private credit, commodities, hedge funds, is either absent or a token allocation of 5% to 10% in the portfolios of more sophisticated retail investors. The 1% portfolio looks dramatically different. The specific allocation data from studies of high net worth and ultra-high net worth portfolios consistently shows 20% to 30% in public equities, 20% to 30% in private equity and venture capital, 15% to 25% in real estate, 10% to 15% in private credit and alternative debt, 5% to 10% in hedge funds, and the remainder in cash equivalents and direct business ownership. The public stock and bond allocation that dominates the conventional portfolio represents only a fraction of the 1% portfolio, and this is not because the 1% have access to superior public market investing. It is because they have access to asset classes that the conventional financial system is not designed to deliver to retail investors. Why the 1% avoid public market concentration? Here's the specific reason that the 1% allocates so much less to public stocks and bonds than conventional financial advice suggests. A reason that is not about the inadequacy of public market returns, but about the specific advantages that alternative assets provide at scale. The public markets are the most efficient component of the investment universe. Thousands of professional analysts are continuously scrutinizing every publicly traded company, which means that the information advantage that produces above-average returns in inefficient markets is largely absent in public ones. The ability to identify and exploit mispricing in Apple or Amazon shares, companies that have hundreds of analysts covering every press release, every earnings call, and every regulatory filing, is genuinely minimal for any investor, including the sophisticated professionals that manage 1% portfolios. Alternative assets, private equity, private real estate, private credit, are significantly less efficient markets. The private company that is not subject to public disclosure requirements, that is not covered by dozens of analysts, and that is not priced continuously by the market offers the specific information advantage and the specific pricing inefficiency that produces above-average returns for sophisticated investors with the access and expertise to exploit them. The 1%'s reduced concentration in public markets is therefore not a preference for complexity over simplicity. It is the rational allocation of capital toward the most inefficient, and therefore the most potentially profitable, markets available, combined with the diversification benefits that uncorrelated alternative asset returns provide alongside public market exposure. The private equity premium, the return, the 1%, capture, that most don't. Here's the specific alternative asset return that most drives the difference between 1% portfolio performance and conventional portfolio performance. The private equity premium, the documented additional return that private equity investment has historically generated over comparable public equity investment. Academic research on private equity returns, the most comprehensive being the Cambridge Associates Private Equity Index and the Preqin Private Equity Database, consistently shows that top quartile private equity funds have historically generated 3% to 5% of additional annual return above comparable public equity over long periods. This premium is not free. It comes with illiquidity. The investment is locked up for 7 to 10 years. Manager selection risk. Private equity returns are more dispersed than public equity returns, meaning poor manager selection can produce returns well below public market alternatives, and the minimum investment requirements that exclude most retail investors from the institutional quality funds. At the portfolio level, a 25% allocation to private equity generating 3% to 5% additional annual return contributes 0.75% to 1.25% of additional annual return to the overall portfolio, which compounded over decades produces meaningfully larger terminal values than the public equity concentration of the conventional portfolio, the accessible version replicating the 1% allocation without the minimums. Here's the honest assessment of which elements of the 1% asset allocation are genuinely accessible to investors without the $5 million to $25 million minimum investment requirements that institutional alternative asset funds typically impose, and the specific vehicles that provide meaningful access to those elements. Public market REITs as the real. Estate allocation. The REIT structure provides exposure to professionally managed, income-producing real estate through publicly traded shares with no minimum investment requirement. The return profile is not identical to direct private real estate investment, but it captures the income return, the inflation protection, and the diversification benefit of real estate exposure with complete liquidity. VNQ, Vanguard Real Estate ETF, and SCHH, Schwab US REIT ETF, provide this exposure at minimal cost. Business development companies, BDCs, as the private credit allocation, BDCs are publicly traded companies that lend to middle market private companies, providing the private credit exposure that the 1% access through institutional private credit funds in a publicly traded, accessible structure. The yield profile of quality BDCs, typically 8% to 12% current yield, reflects the private credit premium over investment-grade public bonds. The risks: credit risk, leverage risk, manager quality across require the same due diligence that any alternative credit exposure requires. Interval funds and non-traded REITs as the semi-liquid alternative exposure. The emergence of semi-liquid investment vehicles, funds that allow quarterly or monthly redemption rather than the 7 to 10 year lockup of institutional private equity funds, has created genuine accessibility to private market asset classes for investors with $10,000 to $25,000 minimums. Blackstone's BREIT, Ares Capital, and Blue Owl Capital's BDC are examples of scaled alternative managers offering semi-liquid structures at minimums accessible to high-income retail investors. Small business direct ownership as the private equity equivalent, the direct acquisition of a small business, described in detail in the Doubling Money video, provides the return profile of private equity ownership through direct operational control rather than through a fund structure. The returns on well-executed small business acquisition are comparable to top quartile private equity at a fraction of the minimum investment. The endowment model, the 1%'s portfolio philosophy at its source. Here's the philosophical framework that underlies the 1%'s asset allocation, the endowment model that was most explicitly articulated by David Swensen, the legendary Yale endowment manager whose portfolio approach produced one of the most successful long-term investment records in institutional investing history. The endowment model's core insight is the specific exploitation of the return premium that illiquidity provides, the documented additional return that investors receive for accepting the illiquidity of alternative assets relative to the perfect liquidity of publicly traded securities. Most investors prefer liquidity, the ability to sell an investment at market price immediately, and this preference is a rational response to uncertainty about future cash needs. Investors who are genuinely certain they will not need the invested capital for 7 to 10 years can accept illiquidity and capture the premium that most investors are paying away in exchange for the liquidity they may not actually need. The endowment model's relevance to the non-endowment investor. The principle of the illiquidity premium is accessible without institutional scale capital. The investor who can genuinely commit capital for 5 to 10 years without needing it, because their emergency fund is fully funded, their near-term spending needs are covered, and their investment horizon is genuinely long, can access the illiquidity premium through the vehicles described above. The investor who cannot genuinely commit capital for that period should not access illiquid alternatives regardless of how attractive the return premium appears. Chapter 2. The Tax Architecture. How the 1% pay a lower effective rate than their assistants. Here's the chapter that produces the most visceral reaction of any topic in personal finance. The specific tax management strategies of the ultra-wealthy that consistently produce effective tax rates below those of middle-income earners, and that are simultaneously entirely legal and genuinely available in modified form to investors at much lower wealth levels. The fact that Warren Buffett famously pays a lower effective tax rate than his secretary is not an accident or a loophole that nobody noticed. It is the direct intended consequence of a specific set of tax code provisions that favor the type of income, long-term capital gains, and qualified dividends that wealthy investors generate in preference to the type of income, wages, and salaries that most working people earn. Understanding this distinction is the foundation of every tax optimization strategy available at any wealth level. The income type hierarchy. Why capital matters more than wages. Here's the specific tax code provision that most directly produces the 1%'s lower effective tax rates, the preferential treatment of long-term capital gains and qualified dividends relative to ordinary income. Ordinary income, wages, salary, interest, short-term capital gains is taxed at marginal rates ranging from 10% to 37% under current federal tax law. The high-income earner in the top bracket pays 37% on each additional dollar of wage income. Long-term capital gains, the profit from selling assets held more than 1 year, is taxed at maximum federal rates of 20% for high-income earners, with an additional 3.8% net investment income tax applying above specific income thresholds. The effective maximum federal rate on long-term capital gains is therefore 23.8%, significantly below the 37% top rate on ordinary income. Qualified dividends, dividends from domestic corporations and certain foreign corporations held for the required period, are taxed at the same preferential rates as long-term capital gains. The mathematical implication of this rate differential. The investor whose income is primarily composed of long-term capital gains and qualified dividends pays approximately 23.8% federal tax on that income at the highest income levels. The employee whose income is primarily composed of salary pays up to 37% federal tax on marginal dollars of income. The 1%'s lower effective tax rate is not a hidden secret or a political scandal. It is the mathematical consequence of having income composed primarily of the tax-preferred types, rather than the ordinary types. The 1%'s tax management therefore begins with the specific portfolio construction that emphasizes long-term capital gain and qualified dividend income over ordinary income, holding investments for more than 1 year before selling, investing in dividend-paying equities rather than interest-bearing bonds and taxable accounts, and structuring business income through entities that allow capital gain treatment of appreciation. The buy, borrow, die strategy, the most powerful tax deferral available. Here's the specific tax management strategy that produces the most dramatic effective tax rate reduction for wealthy investors. The buy, borrow, die strategy that allows the appreciation in a portfolio to be accessed during life without triggering capital gains tax and to be eliminated entirely at death through the stepped-up basis provision. The strategy works as follows. The investor buys appreciating assets, stocks, real estate, private business interests, and holds them indefinitely rather than selling. As the assets appreciate, the investor does not sell to realize gains and does not pay capital gains tax. Instead, the investor borrows against the appreciated assets through portfolio margin loans, securities-backed lines of credit, or real estate mortgage refinancing to generate the cash needed for living expenses and additional investment. The borrowed cash is not income and is not taxable. The loan is secured by the appreciated assets. When the investor dies, the assets receive a stepped-up basis. The cost basis for tax purposes resets to the fair market value at the date of death, eliminating the capital gains tax that would have been due on the appreciation during the investor's lifetime. The heirs inherit the assets at the stepped-up basis and owe no capital gains tax on the pre-death appreciation. The result? The investor accesses the wealth represented by the appreciated assets during their lifetime through tax-free borrowing, and the capital gains tax on the lifetime appreciation is eliminated at death through the stepped-up basis. The effective capital gains tax rate on a lifetime of investment appreciation under this strategy approaches zero. The strategy is not without risks. The margin loans and securities-backed credit lines that finance the borrowing are callable. The lender can demand repayment at any time, which creates specific risk. During market downturns when asset values decline and loan-to-value ratios are tested simultaneously, The 2008 financial crisis produced multiple cases of wealthy investors who had borrowed heavily against concentrated stock positions and faced catastrophic margin calls when stock prices declined. The accessible version, the principle of holding appreciated assets rather than selling them, deferring capital gains indefinitely, and allowing the deferred tax liability to compound additional investment returns, is available to any investor regardless of wealth level. The securities-backed borrowing component requires a portfolio large enough to generate meaningful loan capacity. The stepped-up basis benefit is available to any investor who holds appreciated assets until death, regardless of the portfolio size. The entity structure layer: corporations, LLCs, and S-Corp. Here's the specific legal infrastructure that the 1% use to manage the tax treatment of their business. And investment income: the entity structures that allow income to be characterized, timed, and transferred in ways that minimize aggregate tax cost across the wealth building and wealth transfer lifecycle. The C Corporation as an investment vehicle: corporate tax rates, currently 21% at the federal level, are significantly below the top individual ordinary income rate of 37%. The investor who structures business or investment activity within a C corporation pays 21% corporate tax on income retained within the corporation, rather than 37% individual tax on the same income if received personally. The after-tax dollars retained in the corporation then compound within the corporate structure, producing a tax deferral benefit on the 16% rate differential that compounds over years. The limitation: taking money out of the C corporation produces dividend taxation at the individual level, the double taxation problem that makes C corporations less attractive for income extraction. Then for income retention: the strategy is most effective when the goal is long-term accumulation within the corporate structure rather than current income extraction. The LLC and pass-through structure: the limited liability company's pass-through taxation, where income flows directly to the individual owner's tax returns without entity-level tax, provides flexibility for real estate and business income structuring that neither the C corporation nor individual ownership provides separately. The LLC can hold real estate and capture depreciation deductions that offset rental income, reducing the effective tax rate on real estate investment income. The S corporation for business income: the S corporation structure allows business owners to take a portion of their business income as salary, subject to payroll tax, and a portion as distributions, not subject to payroll tax. For high-income business owners whose payroll tax liability is significant, the S corporation structure produces meaningful tax savings by minimizing the salary component subject to payroll tax, while maximizing the distribution component that escapes it. The charitable strategy: how giving becomes tax management. Here's the tax management strategy that most effectively combines genuine philanthropic intent with sophisticated tax reduction: the donor-advised fund and the charitable remainder trust that allow significant charitable giving to produce immediate tax deductions while preserving the economic benefit of the contributed assets for the donor during their lifetime. The donor-advised fund is the most accessible charitable tax strategy, available to anyone with investable assets to contribute with no minimum contribution requirement at most providers. The investor contributes appreciated assets, stocks, real estate interests, private business shares, to the DAF, receiving an immediate charitable deduction for the full fair market value of contributed assets without realizing the capital gain. The assets are then sold within the DAF without capital gains tax, and the proceeds are invested and eventually distributed to the investor's chosen charitable organizations. The tax arithmetic of the DAF: an investor contributes $100,000 of stock with a $10,000 cost basis. Outside the DAF, selling the stock would produce $90,000 of long-term capital gain and $20,000 of capital gains tax at the 22.4% combined federal rate. Contributing to the DAF eliminates the capital gains tax and produces a $100,000 charitable deduction that reduces the investor's taxable income by $100,000, saving the investor up to $37,000 in income taxes. The combined benefit, eliminated capital gains tax plus income tax savings, is approximately $57,000 from a $100,000 contribution. Chapter 3: the professional team. Who the 1% hire and why it matters. Here's the chapter that addresses one of the most consistently underappreciated aspects of 1% money management, the specific professional relationships that wealthy individuals maintain, the specific functions those professionals serve, and the specific way in which having the right professionals generates financial returns that significantly exceed the cost of employing them. Most people's experience with financial professionals is limited to a single relationship: a financial advisor who manages their investment portfolio, and occasionally a tax preparer who files their annual return. The 1%'s professional team is dramatically broader, more specialized, and more integrated than this, and the integration is as important as the individual professional's expertise, because the value of coordinated professional advice on investment, tax, legal, and insurance strategy simultaneously is greater than the sum of the parts. The family office, the ultimate integration vehicle. Here's the professional structure that represents the pinnacle of integrated wealth. Management, the family office, and why it produces better financial outcomes than the fragmented professional relationships that most investors maintain. A family office is a private wealth management firm established by a single ultra-high net worth family, typically with $100 million or more in investable assets, to coordinate all aspects of the family's financial, legal, and administrative needs through a single integrated team. The family office employs investment professionals, tax attorneys, estate planners, insurance specialists, and administrative staff who work exclusively for the family, coordinating every financial decision across all disciplines simultaneously. The specific return on the family office investment comes from the coordination benefit, the tax and investment decisions that are not made in isolation from each other, but are coordinated to optimize the aggregate outcome. The investment allocation decision is made simultaneously with the tax efficiency decision, the estate planning decision, and the insurance risk management decision. The portfolio rebalancing that would generate capital gains is coordinated with the charitable giving strategy that offsets those gains. The business exit that produces a large capital gain is coordinated with the qualified opportunity zone investment that defers it. The fragmented professional team, the investment advisor who doesn't know what the tax attorney is doing, the estate planner who doesn't know what the insurance broker is structuring, produces outcomes that are individually reasonable and collectively suboptimal, because each professional is optimizing their specific domain without visibility into the other domains. The accessible version: building a coordinated team without the family office. Here's the honest assessment of how to replicate the coordination benefit of the family office without the $100 million asset minimum. The specific professional team that high-income, high-net-worth individuals below the family office threshold can assemble to capture most of the integration benefit. The fee-only fiduciary financial planner. The cornerstone of the accessible professional team is a financial planner who is compensated only by client fees, not by commissions on the products they recommend, and who is legally required to act in the client's interest rather than in their own. The fee-only fiduciary is the closest accessible equivalent to the family office investment professional, and the distinction between fee-only fiduciary advice and commission-based financial product sales is the single most important professional relationship distinction in personal finance. The fee structure matters because it determines whose interest the advisor is optimizing. The commission-based financial advisor generates income from recommending specific products, certain mutual funds, insurance products, annuities, and creating the specific conflict of interest that aligns the advisor's income with product sales rather than with client outcomes. The fee-only fiduciary's income comes from the client regardless of what the client invests in, eliminating the product recommendation conflict. The specific certification to look for: the Certified Financial Planner, CFP designation combined with fee-only compensation structure, searchable at napfa.org, the National Association of Personal Financial Advisors, which requires members to be both fee-only and fiduciary. The tax attorney, or CPA, with specialty in wealth management. The tax professional in the coordinated team is not the accountant who prepares the annual tax return. It is the CPA, or tax attorney, with specific expertise in tax planning, entity structuring, and the proactive identification of tax reduction opportunities. The distinction between tax preparation, reporting what happened, and tax planning, structuring what will happen to minimize tax. is the distinction between the reactive tax professional most people use and the proactive tax professional the 1% employ. The estate planning attorney. The estate planning attorney structures the legal documents, wills, trusts, power of attorney, healthcare directives that determine what happens to accumulated wealth at death and incapacity. The specific structures available: revocable living trusts, irrevocable trusts, charitable trusts, grantor-retained annuity trusts, can dramatically reduce estate tax liability and ensure that accumulated wealth transfers to the intended beneficiaries in the intended manner. The independent insurance specialist, the insurance professional in the coordinated team, is not a captive agent who sells products from a single company. It is an independent broker who assesses the full insurance need and recommends the most cost-effective products from across the market. The specific insurance needs of the high-income, high-net-worth individual, umbrella liability, life insurance structured for estate liquidity rather than income replacement, disability income protection, key person business insurance, are significantly more complex than the standard insurance needs of the average household. The specific question that transforms professional relationships. Here's the specific question that the 1% ask their professional team that most people never ask their professionals. The question that converts a reactive advisory relationship into a proactive wealth-building partnership. The question is, what should I be doing that I'm not currently doing? Not, how did I do last year? Not, what do you think the market will do? Not, should I make any changes to my portfolio? But the specific open-ended invitation to the professional to proactively identify opportunities, vulnerabilities, and improvements in the client's financial situation that the client's own awareness has not reached. The financial advisor who is asked this question and has a genuine answer, specific, actionable, and beyond the client's current awareness, is providing the specific proactive value that justifies the advisory fee. The financial advisor who responds to this question with vague reassurances about long-term investing is providing transaction services dressed in advisory language. The 1% ask this question of every professional on their team, at every meeting. The answers they receive, the tax strategies identified by the proactive CPA, the estate planning opportunity identified by the attorney who reviewed the current structure, the insurance gap identified by the independent broker, are the specific proactive value that the professional team provides and that the individual advisor relationship rarely delivers. The negotiation of professional fees. Here's the specific practice that the 1% apply to professional relationships that most people don't apply and that produces meaningful cost savings. The direct negotiation of professional fees is a normal part of establishing and maintaining professional relationships. Most people treat professional fees as fixed prices. The stated rate that the professional charges is accepted without negotiation. The 1% treat professional fees as negotiable, and they are in virtually every professional service context. The financial advisor's fee can be negotiated, particularly for larger accounts. The attorney's hourly rate can be negotiated, particularly for ongoing relationships. The CPA's annual fee can be negotiated, particularly when multiple services are engaged simultaneously. The specific negotiation leverage available to any client is the value of the ongoing relationship, the expected multi-year revenue stream that the client represents, versus the cost of acquiring a new client to replace them. For most professional service providers, the ongoing client relationship is significantly more valuable than the initial engagement, and the client who demonstrates awareness of this dynamic and uses it to negotiate has genuine leverage. Chapter 4. The Debt Philosophy, How the 1% Use Debt as a Wealth Tool. Here's the chapter that addresses the most misunderstood aspect of 1% money management, their relationship with debt. The conventional financial advice for ordinary people is simple and largely correct at the household level. Avoid debt, pay off what you have, don't borrow money to buy things that go down in value. This advice produces reasonable financial outcomes for most households and is broadly defensible as a financial philosophy for the typical consumer. The 1% don't follow this advice, not because they're irresponsible or financially reckless, but because they operate with a fundamentally different understanding of what debt is, what it can be used for, and how the specific economics of leveraged investment produce outcomes that unleveraged investment cannot. Approach. The specific difference is not between responsible and irresponsible debt use. It is between consumer debt, borrowed money used to fund consumption that produces no financial return, and investment debt, borrowed money used to acquire assets that generate returns exceeding the cost of the borrowing. The 1% are not anti-debt. They are anti-consumer debt and enthusiastically pro-investment debt. And the distinction between these two categories is the specific insight that makes debt a wealth-building tool rather than a wealth-destroying trap. The cost of capital concept, the foundation of investment debt. Here's the specific analytical framework that the 1% apply to every debt decision, and that most people never consciously apply to any debt decision. The cost of capital analysis. Every debt has a cost. The interest rate that must be paid on the borrowed principal. Every investment has an expected return. The income and appreciation generated by the asset purchased with the borrowed funds. The investment debt decision is profitable when the expected return on the acquired asset exceeds the cost of the borrowed capital. It is unprofitable when the cost of the capital exceeds the expected return. This analysis is the foundation of every leverage buyout in private equity, every real estate investment with mortgage financing, every corporate capital structure decision, and every 1% portfolio decision that involves borrowed capital. It is also entirely applicable to the financial decisions of households with a fraction of the 1%'s wealth, but it requires applying the analysis honestly rather than using the expected return assumption to justify debt that the honest analysis would not support. The honest application of cost of capital analysis reveals the specific debt decisions that are genuinely wealth-building and the specific debt decisions that feel like wealth-building but aren't. Borrowing at 7% mortgage interest to purchase a rental property generating 12% total return is profitable cost of capital deployment. Borrowing at 22% credit card interest to purchase equipment for a business that generates 15% return is not. The cost of capital exceeds the expected return, making the debt a guaranteed wealth destroyer. The 1% apply this analysis to every debt decision with a specificity and rigor that most people never apply to any debt decision. The result is a portfolio that uses debt wherever the return to cost differential is favorable and avoids debt everywhere else. Not because debt is philosophically objectionable, but because the analysis doesn't support it. The leverage amplification, how debt multiplies returns. Here's the specific mathematical mechanism through which investment debt amplifies returns on invested equity. The specific reason the 1% use leverage in their investment portfolios and the specific reason it produces higher returns on equity than unleveraged investment at equivalent asset performance. The example from real estate, the most intuitive leverage vehicle, an investor purchases a $1 million commercial property with $250,000 equity and $750,000 mortgage debt at 6% interest. The property generates $80,000 per year in net operating income, an 8% return on the total asset value. After paying $45,000 per year in mortgage interest, the remaining $35,000 flows to the equity investor. The return on the $250,000 equity investment is $35,000 divided by $250,000, 14%, compared to the 8% return on the total asset that would be the return for an all-cash buyer. The leverage has amplified the equity return from 8% to 14%, a 75% improvement in return on invested capital from the identical underlying asset, simply by financing a portion of the purchase with debt at a cost below the asset's return. This is the mathematical foundation of why sophisticated real estate investors use significant mortgage financing rather than paying cash. Not because they can't afford cash, but because the leverage improves the return on their equity capital. The same leverage amplification applies in private equity buyouts, in venture lending, in leveraged stock portfolio strategies, and in every investment context where the asset return exceeds the financing cost. The 1% systematically use leverage where this differential exists and systematically avoid it where it doesn't, which is the specific debt philosophy that produces their wealth accumulation trajectory. The securities-backed line of credit, the 1%'s preferred liquidity tool. Here's the specific debt instrument that the 1% use most consistently and that most people have never encountered, the securities-backed line of credit, or SBLOC, that allows investors to borrow against their investment portfolio without selling the underlying investments. The SBLOC mechanics: the investor pledges their investment portfolio, stocks, bonds, index funds, as collateral for a revolving line of credit at the brokerage or bank. The credit line is typically 50% to 70% of the pledged portfolio value. The interest rate is typically 1% to 3% above SOFR, the secured overnight financing rate, currently producing rates of 5% to 7% for most borrowers. The interest is charged only on the amount drawn, not on the full credit line. The specific use cases where the SBLOC produces superior outcomes to the alternatives. First use case, bridging a liquidity need without selling investments. The investor who needs $200,000 for a home renovation, a business opportunity, or a large tax payment can draw from the S-block rather than selling $200,000 of appreciated investments and triggering capital gains tax on the sale. The S-block interest cost, 6% on $200,000 is $12,000 per year, is frequently less than the capital gains tax that the equivalent sale would produce, particularly for highly appreciated positions. Second use case, funding investment. Opportunities without waiting for asset sales. The investor who identifies an attractive real estate purchase or business acquisition opportunity can draw from the SBLOC to fund the opportunity quickly, without the delay of selling portfolio investments, finding buyers and waiting for settlement, and then repay the SBLOC from the operating cash flow of the acquired asset. Third use case, the buy, borrow, die strategy described in Chapter 2, accessing the appreciation in a concentrated stock position through borrowing rather than selling, deferring the capital gains tax indefinitely. The specific risks of the SBLOCs that require understanding before use. The credit line is callable, meaning the lender can demand repayment at any time. During significant market declines, when the collateral value falls and the loan-to-value ratio approaches the lender's limit, the investor faces a margin call, the requirement to either repay the loan or provide additional collateral. If neither is possible at the time of the margin call, the lender sells the pledged investments to repay the loan, potentially at the worst possible moment, locking in losses that patient holding would have recovered from. The position sizing rule for SBLOC use. The outstanding SBLOC balance should never exceed 30% of the pledged portfolio value, regardless of the maximum available. This buffer, between the 30% borrowed and the 50% to 70% lender limit, provides sufficient cushion to absorb a significant market decline without triggering a margin call. The investor who borrows to 60% of portfolio value and experiences a 30% market decline has their effective loan-to-value ratio increase from 60% to 86%, approaching the lender's limit and creating serious margin call risk. The investor who borrows to 30% and experiences the same 30% decline has effective loan-to-value increase from 30% to 43%, comfortably below any lender's limit. The carried interest conversation. How business debt creates tax-preferred returns. Here's the specific debt-related tax strategy that is most exclusive to the 1% and that produces some of the most dramatic examples of effective tax rate reduction: the use of debt financing in business and investment structures to convert ordinary income into capital gain. In private equity, the fund manager's compensation structure and the carried interest is structured as a share of the fund's investment profits rather than as a fee for services. Because the profits are long-term capital gains generated by the fund's investments, the carried interest income is taxed at capital gains rates rather than ordinary income rates, producing the specific result that private equity fund managers pay capital gains tax rates on income that functions economically as compensation for services. This structure is the subject of ongoing political debate about whether it represents appropriate tax policy, but it remains current law. And it represents the 1% systematic structuring of income as capital gain rather than ordinary income wherever the tax code permits. The principle, maximizing the fraction of income that qualifies for capital gains treatment, is applicable at every wealth level and is the specific tax philosophy that produces the rate differential between the 1% and their employees. The debt hierarchy for non-1%. Implementation. Here's the specific debt hierarchy that applies the 1%'s debt philosophy to a financial life that is not at the 1% level. The specific sequencing of debt that maximizes the wealth-building use of borrowing while eliminating the wealth-destroying use. Level 1, eliminate immediately, consumer debt with no investment return component, credit card balances, personal loans, auto loans on depreciating vehicles. These are the clearest examples of negative return debt, where the interest cost is guaranteed and the asset return is zero or negative. Level 2. Acceptable, manage carefully, mortgage debt on a primary residence at reasonable loan-to-value ratios. The primary residence generates a return through housing cost savings rather than through income, and the return is not easily quantified or guaranteed. The acceptable level is sufficient leverage to enable homeownership in the relevant market without overextending monthly cash flow obligations. Level 3. Strategically deploy mortgage debt on income-producing real estate where the total return on the property, income plus appreciation, exceeds the mortgage interest cost. The real estate leverage analysis from earlier in this chapter applies. The leverage is wealth building when the differential is positive and wealth destroying when it isn't. Level 4. Advanced deployment, securities-backed borrowing for liquidity bridging and investment opportunity funding, sized at no more than 30% of the pledged portfolio value and used only when the specific use case is financially superior to the alternative. Chapter 5. The Estate Planning Infrastructure, How the 1% Keep Wealth in the Family. Here's the chapter that addresses the specific mechanisms through which the 1% ensure that accumulated wealth transfers efficiently to the next generation, minimizing the estate tax that can claim up to 40% of estates above the federal exemption threshold, and structuring the transfer in ways that maintain the financial management philosophy alongside the financial assets. Estate planning is the area of wealth management that most people defer the longest, because it requires confronting mortality, because it involves complex legal structures, and because the benefits accrue to future generations rather than to the person making the decisions. The 1% treat estate planning as an integral component of current wealth management rather than as a future-dated problem. Because the most effective estate planning strategies require years or decades to implement fully, and delay is expensive, both in missed planning opportunities and in the tax cost of unplanned wealth transfer. The federal estate tax, who it affects, and how much. Here's the specific scope of the federal estate tax, the tax that makes estate planning financially significant for the households this chapter is relevant to. The federal estate tax applies to estates above the exemption threshold, currently $13.61 million per individual and $27.22 million per married couple under the Tax Cuts and Jobs Act provisions that are scheduled to sunset after 2025, potentially reducing to approximately $7 million per individual and $14 million per couple. Estates above the applicable exemption pay federal estate tax at a 40% marginal rate on the excess. The specific implication: a $20 million estate above a $7 million exemption has $13 million subject to the 40% rate, producing a $5.2 million estate tax liability. Without planning, the estate transfers $14.8 million to heirs rather than $20 million. With effective planning, the estate tax liability can be dramatically reduced or eliminated through the specific structures described in this chapter. The planning window. The most effective estate tax reduction strategies require time to implement fully. The grantor retained annuity trust requires the grantor to survive the trust term. The irrevocable life insurance trust requires the policy to be in force for 3 years before the death benefit is excluded from the estate. The family limited partnership requires years of operation to establish the valuation discount that reduces the taxable estate value. Every year of delayed estate planning is a year of missed planning opportunity that cannot be recovered. The trust structures. The 1%'s estate planning toolkit. Here's the specific catalog of trust structures that the 1% use most consistently to transfer wealth while minimizing estate tax, each with its specific mechanism, its specific benefit, and its specific limitations. The revocable living trust, the foundational estate planning structure that avoids probate, the court-supervised asset distribution process that is public, time-consuming, and expensive by holding assets in a trust rather than in the individual's personal name. The revocable living trust does not reduce estate taxes. The trust assets remain in the taxable estate, but it ensures that assets transfer to beneficiaries efficiently and privately without the probate process. Every estate plan should include a revocable living trust as its foundation. The Irrevocable Life Insurance Trust, ILIT, the specific structure that removes the death benefit of life insurance from the taxable estate, which it would otherwise be included in if the deceased owned the policy. The ILIT owns the life insurance policy rather than the individual, receiving the death benefit at death and distributing it to heirs free of estate tax. A $5 million life insurance policy owned personally is included in the taxable estate and taxed at 40%, producing $2 million of estate tax on the death benefit. The same policy owned by an ILIT excludes the $5 million death benefit from the estate, eliminating the $2 million estate tax cost. The grantor retained annuity trust, GRAT, the specific structure that allows appreciated assets to be transferred to heirs with minimal gift tax by giving the IRS a below-market interest rate on the transfer. The grantor contributes assets to the GRAT and receives a fixed annuity payment for the trust term. At the end of the term, the remaining assets, which have hopefully grown beyond the IRS's assumed growth rate, transfer to heirs free of gift or estate tax. The GRAT is most valuable for highly appreciating assets, concentrated stock positions, private equity interests, where the expected return significantly exceeds the IRS's assumed rate. The Family Limited Partnership, FLP, or Family Limited Liability Company, FLLC, the specific structure that allows family-controlled assets to be transferred to heirs at a valuation discount relative to the asset's underlying market value. The logic? A minority interest in a family partnership, an interest that cannot be sold easily or liquidated without the consent of the other partners, is worth less than a pro rata share of the underlying assets because the buyer of the minority interest has limited control and limited liquidity. This valuation discount, typically 20% to 40%, reduces the taxable gift value of the transferred interest, allowing more wealth to transfer using the annual gift exclusion and lifetime exemption. The Accessible Estate Planning Foundation. Here's the estate planning infrastructure that is appropriate for households below the estate tax threshold. The specific documents and structures that ensure accumulated wealth transfers efficiently to intended beneficiaries regardless of whether the estate tax is relevant. The will, the specific legal document that designates the distribution of assets at death, who receives what, in what proportion, with what conditions. The absence of a will produces intestate succession, the court-determined distribution according to state law that may not reflect the deceased's intentions, and that produces administrative costs and delays that a will prevents. Every adult with any meaningful assets should have a will. The Revocable Living Trust, the specific structure that avoids probate and ensures private, efficient asset distribution. Assets held in the trust at death transfer to beneficiaries according to the trust terms without court involvement. Assets not held in the trust, because they were not transferred to the trust during the owner's lifetime, go through probate regardless of the will. The beneficiary designations, the specific administrative documents that determine who receives retirement accounts, life insurance policies, and accounts with transfer on death designations, all of which pass outside the will and outside the trust regardless of what those documents say. The retirement account that names an ex-spouse as beneficiary because the form was never updated after the divorce transfers to the ex-spouse, despite the will's contrary instructions. Beneficiary designation review at every major life change and at least every 5 years is among the most financially important administrative tasks in personal finance. The Power of Attorney and Healthcare Directive, the specific legal documents that designate who makes financial and medical decisions in the event of incapacity, avoiding the court-supervised guardianship process that applies in the absence of these documents and that is both expensive and may produce decisions the incapacitated person would not have made. The Annual Gift Exclusion Strategy, gradual wealth transfer. Here's the specific estate tax reduction strategy that is available to any household with estate tax exposure and that requires no complex trust structures, the systematic use of the annual gift exclusion to transfer wealth to heirs during the donor's lifetime rather than at death. The annual gift exclusion allows each individual to give up to $18,000 per year, as of current limits, indexed for inflation, to any number of recipients without gift tax and without using the lifetime exemption. A married couple can give $36,000 per year per recipient. A married couple with 3 adult children and 6 grandchildren can transfer $324,000 per year, $36,000 times 9 recipients, completely free of gift tax and outside the estate. Over 10 years, the systematic use of the annual gift exclusion by this hypothetical family transfers $3,240,000 out of the taxable estate, saving $1,296,000 in estate tax at the 40% rate, through the simple administrative act of making annual gifts to family members. The strategy is more powerful when combined with 529 education account funding, allowing 5 years of contributions to be made at once through superfunding, transferring $90,000 per individual or $180,000 per couple per beneficiary in a single gift that is excluded from the taxable estate immediately. Chapter 6. The Risk Management Architecture: How the 1% Protect What They've Built. Here's the chapter that addresses the most consistently overlooked component of 1% money management. Not how they build wealth, but how they protect it once built. Because here's the specific financial reality that the wealth accumulation focus of most financial content misses. The ability to build wealth and the ability to protect it are distinct skills requiring distinct strategies, and the failure to protect accumulated wealth produces outcomes that make all the building effort irrelevant. The 1% allocate specific, deliberate, professional attention to risk management, to the identification and mitigation of the specific threats that could diminish or eliminate accumulated wealth, with the same rigor and the same professional infrastructure that they apply to wealth accumulation. The risk management infrastructure is not an afterthought added to the investment strategy. It is a co-equal component of the overall wealth management architecture, the catastrophic loss hierarchy. What the 1% are actually afraid of. Here's the specific catalog of catastrophic financial risks that the 1% most actively manage. The specific loss scenarios that their risk management architecture is designed to prevent, organized by magnitude and likelihood. Catastrophic risk: 1. Liability judgment in excess of insurance coverage. The wealthy individual or family is a specific target for liability claims, personal injury lawsuits, business litigation, professional liability claims that, if successful at a level above insurance coverage, can result in personal asset seizure to satisfy the judgment. The specific scenario: a lawsuit that produces a $10 million judgment against an individual whose liability insurance covers only $3 million. The $7 million excess is collectible from the individual's personal assets, the investment portfolio, the real estate, the business interests. Catastrophic risk 2. Catastrophic health event without adequate insurance coverage or income protection. The high-income individual who becomes unable to work due to disability faces the specific financial catastrophe of losing the income that their lifestyle and wealth accumulation strategy depends on. The disability insurance gap, between what employer-provided disability coverage pays and what the individual's actual income was, is a specific and significant financial vulnerability for high-income earners. Catastrophic risk 3. Concentrated position collapse. The wealthy individual whose wealth is primarily concentrated in a single asset, a single company's stock, a single business, a single piece of real estate, faces the specific catastrophe of that asset's value declining dramatically or going to zero. The executive with 80% of net worth in company stock, the entrepreneur with 90% of net worth in the private business, the real estate investor with 70% of net worth in a single property, all face concentration risk that could eliminate most of their accumulated wealth in a single adverse event. Catastrophic risk 4. Divorce without prenuptial or postnuptial protection. The high net worth individual who divorces without protective legal structure faces the specific financial consequence of equitable distribution, the division of marital assets that, depending on state law and the specific circumstances, can result in transferring 50% of accumulated wealth to the ex-spouse. The insurance architecture: what the 1% actually buy. Here's the specific insurance portfolio that the 1% maintain, different in kind and in scale from the insurance coverage most households carry, organized by the specific catastrophic risks they address. Umbrella liability insurance, the foundational liability protection that extends the coverage limits of homeowners and auto insurance to $1 million, $5 million, or $10 million above the underlying policies. The umbrella policy covers the excess liability judgment that the underlying policies don't. The scenario described above where a lawsuit produces a judgment above the auto or homeowner's policy limit. The cost of umbrella coverage is remarkably low relative to the protection provided, typically $200 to $400 per year per $1 million of coverage, making it one of the highest value insurance purchases available. For high net worth individuals, the umbrella coverage should be sized to at least equal the total value of the protectable assets, the assets that a creditor could potentially collect from a judgment. An individual with $5 million in protectable assets and $3 million in umbrella coverage is self-insuring $2 million of the exposure. An individual with $5 million in umbrella coverage has fully transferred the liability exposure to the insurance carrier. Private directors and officers D&O insurance. The high net worth individual who serves on corporate boards, nonprofit or for-profit, faces specific personal liability exposure from actions taken in the board capacity that personal umbrella insurance typically does not cover. D&O insurance covers the defense costs and judgment exposure from claims arising from board service. The cost is modest relative to the exposure, and the coverage is a specific requirement for anyone serving in a board capacity with meaningful personal asset exposure. High-limit disability income insurance. The standard employer-provided group disability insurance typically covers 60% of base salary to a maximum benefit of $10,000 to $15,000 per month. An adequate replacement for moderate income earners, but a significant shortfall for high-income earners. The executive earning $500,000 per year, whose disability income coverage caps at $15,000 per month, $180,000 per year, has a $320,000 annual income gap that disability does not cover. The private disability market offers individual policies that supplement group coverage, covering a higher percentage of income and including bonus and business income in the disability benefit calculation, for high-income earners whose group coverage leaves significant gaps. The cost is meaningful. High-income disability coverage is expensive because the benefit is expensive, but the income replacement protection is the specific financial foundation that makes all other wealth management strategies sustainable in the event of the most common catastrophic financial event available to working-age individuals: life insurance for estate liquidity for estates above the estate tax threshold. The life insurance death benefit provides the cash needed to pay estate taxes without forcing the liquidation of illiquid assets, the family business, the real estate portfolio, the concentrated stock position, at whatever price a forced sale under a tax deadline produces. The policy is held in the ILIT to exclude the death benefit from the taxable estate. The asset protection structure, making assets difficult to collect. Here's the specific legal infrastructure the 1% use to make their assets difficult for potential creditors to access. The entity structures and titling strategies that convert the directly collectible personal assets into assets that are protected by legal structures. The limited liability company as an asset protection vehicle, assets held in an LLC, particularly real estate, are generally not directly collectible by personal creditors of the LLC owner, though the LLC membership interest itself may be attachable depending on state law. The specific protection varies by state, with states like Nevada, Delaware, and Wyoming providing the strongest creditor protection for LLC structures. The real estate investor who holds each property in a separate LLC has limited their personal liability exposure from any single property to their equity in that LLC, rather than to their entire personal asset base. The retirement account protection, ERISA qualified retirement accounts, 401ks pension plans, are protected from creditor claims by federal law in most circumstances, providing a specific asset protection benefit for the assets accumulated in employer-sponsored retirement accounts. IRA protections vary by state, but are significant in most jurisdictions. The retirement account is therefore one of the most creditor-protected investment vehicles available, making maximization of retirement account contributions a risk management strategy alongside its tax and wealth accumulation benefits. The homestead exemption. Most states provide a homestead exemption that protects a portion of the primary residence's equity from creditor claims. The specific amount varies dramatically by state. Florida and Texas provide unlimited homestead exemption, meaning the full value of the primary residence is protected from creditors, while most other states provide more limited exemptions of $50,000 to $500,000. The homestead exemption is a specific consideration in the choice of state of residency for high net worth individuals with significant home equity. The diversification imperative, the risk management. That investment strategy also serves. Here's the specific connection between the investment diversification described in Chapter 1 and the risk management architecture described in this chapter. The specific way that broad diversification serves both return optimization and catastrophic loss prevention simultaneously. The concentrated position, the investment portfolio that is 70% or more in a single company's stock, a single asset class, or a single geographic market, is the specific portfolio configuration that makes the catastrophic loss scenario most possible. When the single concentrated position collapses, as Enron's employees' 401k portfolios discovered in 2001, as Lehman Brothers employees discovered in 2008, as countless cryptocurrency concentrated investors discovered in 2022, the portfolio collapse is total rather than partial. Diversification is therefore not primarily an investment optimization strategy, the reduction of variance for a given expected return that the textbook describes. It is the specific risk management strategy that prevents the concentrated position collapse from producing the catastrophic loss scenario that makes all subsequent wealth management irrelevant. The 1% maintain diversification, not because they've read the efficient frontier literature, but because they've seen what concentration does when it goes wrong, and they prefer to capture 90% of the potential upside rather than accept 100% of the potential catastrophic downside. The specific diversification standard that provides genuine catastrophic loss protection. No single position. Individual stock, individual property, individual business should represent more than 10% to 15% of total investable net worth. Above this concentration level, the specific risk of catastrophic loss from a single adverse event is meaningful and requires explicit active management. Chapter 7. The Income Architecture, How the 1% Structure Their Earnings. Here's the chapter that addresses the specific way the 1% structure the income side of their financial lives, not just how much they earn, but how they earn it, in what form it arrives, through what legal structures it flows, and with what specific tax and wealth-building consequences those structural choices produce. The income architecture of the 1% is dramatically different from the income architecture of the typical high-earning professional, not primarily because they earn more, but because they have structured their income to arrive in forms that build wealth, minimize tax, and create the specific compounding effects that salary and wages alone cannot produce. The multiple income stream philosophy. Here's the foundational income philosophy of the 1% that most fundamentally distinguishes their income architecture from the standard employment model. The deliberate construction of multiple simultaneous income streams that operate across different risk profiles, different tax treatment categories, and different dependency relationships with the owner's active time. The typical high-income professional has one income stream, the salary or professional income from their primary employment or practice. This income stream has specific characteristics. It is fully dependent on the professional's continued active participation. It is taxed as ordinary income at the highest applicable rate. It ceases entirely if the professional becomes unable to work, and it has a ceiling determined by the number of hours in a day and the professional's specific market compensation. The 1%'s income architecture typically includes 5 to 8 simultaneous income streams operating across different characteristics. The active earned income from their primary business or professional activity, which is the base and typically the largest single stream. The passive income from real estate holdings, rental cash flow that requires management but not hourly labor, the portfolio income from investments, dividends, interest, and capital gains distributions, the business ownership income from businesses they own but don't actively manage, minority equity positions, franchises, or acquired businesses with hired management, the royalty or intellectual property income from created assets, patents, published content, licensed brand or technology, the board, and advisory compensation from companies where they provide strategic rather than operational input, and the carried interest or profit participation from investment structures they've organized, the general partner's share of investment returns from a partnership they've sponsored. Each additional income stream beyond the first provides two specific benefits. It reduces the total income risk by diversifying away from single-source dependency, and it introduces income with different tax treatment than ordinary employment income, reducing the aggregate effective tax rate across all streams combined. The salary versus distribution decision, the business owner's core tax choice. Here's the specific income structuring decision that most directly affects the tax treatment of business owner income, the division between salary and distribution for the owner of a pass-through business entity, and the specific optimization that the 1% execute on this decision that most small business owners approach suboptimally. Business owners who operate through S corporations must pay themselves a reasonable salary for the services they provide to the business. That salary is subject to payroll taxes at a combined rate of 15.3% on the first $168,600 and 2.9% above that threshold. Business profits above the salary that are distributed to the owner as a shareholder distribution are not subject to payroll tax, they are subject only to income tax. The optimization, the salary should be set at the lowest defensible reasonable compensation for the services the owner provides. Defensible meaning it would withstand IRS scrutiny as genuinely comparable to what the business would pay a third party for those services, while the remaining distributable profit flows as distributions exempt from payroll tax. The specific tax saving on each dollar of business income that is structured as distribution rather than salary is the 15.3% payroll tax for income below $168,600 or 2.9% above that threshold. For a business generating $500,000 in profit where the owner takes a $150,000 salary, the distribution of $350,000 saves approximately $10,150 in Medicare tax, 2.9% of $350,000, compared to treating the full $500,000 as salary. This saving recurs annually, compounding into significant wealth accumulation over a career. The qualified business income deduction. The 20% deduction. Most business owners underutilize. Here's the specific tax provision that the Tax Cuts and Jobs Act created for pass-through business owners. The qualified business income, QBI, deduction that allows eligible business owners to deduct up to 20% of their qualified business income from taxable income, effectively reducing the tax rate on that income by 20%. For a business owner in the 37% marginal tax bracket with $500,000 of qualified business income, the 20% QBI deduction produces a $100,000 deduction, reducing the taxable business income to $400,000 and saving $37,000 in federal income tax annually. The QBI deduction is subject to income phase-outs and limitations that apply differently to different business types, making professional guidance essential for optimizing its application. The specific eligibility rules, the wage and property limitations that cap the deduction for high-income business owners, and the specified service business restrictions that limit the deduction for certain professional services are sufficiently complex that the QBI deduction is among the most frequently misapplied provisions in the tax code, and among the most valuable when correctly applied. The royalty and intellectual property income stream. Here's the specific income stream that the 1% most consistently build as a complement to their active business income. The royalty stream from intellectual property that generates recurring income from work created once. The intellectual property royalty stream takes different forms depending on the creator's domain. The published author who receives royalties on book sales, the inventor who receives licensing royalties from a patented technology, the software developer who receives licensing fees from created code, the content creator who receives platform revenue from published content, the musician who receives performance and synchronization royalties from created compositions. The specific wealth-building characteristics of royalty income. It requires active creation once and then generates income with minimal ongoing labor. The effective hourly rate on established royalty income, measured as annual royalty revenue divided by the hours required to maintain and renew it, can reach extraordinary levels for successful intellectual property. The tax treatment of royalty income is ordinary income, no special preference, but the income is generated without payroll tax for self-employed creators who have structured their intellectual property correctly. The accessible version for most people. Digital content, YouTube channels, newsletters, podcasts, online courses, generates the closest accessible equivalent to royalty income for people without patents or traditional publishing relationships. The content created in year 1 continues generating advertising, sponsorship, and subscription revenue in years 3, 5, and 10 without proportional additional labor. The compounding income characteristic that makes royalty streams so valuable in a multiple income stream architecture, the passive income threshold, when money works without you. Here's the specific income milestone that the 1% income architecture is organized around, the threshold at which passive income from invested assets covers total living expenses, making all active income accumulation rather than survival. The passive income threshold is the specific dollar amount of annual income generated by the investment portfolio, dividends, distributions, rental income, royalties, that equals the household's annual spending. When passive income exceeds spending, the active income that was previously required for survival is entirely available for additional accumulation. The effect on the wealth accumulation trajectory is dramatic. Instead of 60% of active income being consumed by spending and 40% being invested, 100% of active income is invested, and the portfolio is growing at the rate of total active income rather than 40% of it. The 1% income architecture is specifically designed to reach this threshold as early as possible and to sustain it indefinitely, creating the specific financial condition where the wealth compounds at the rate of total income rather than at the rate of the savings fraction of income. Chapter 8: The Investment Decision Framework. How the 1% Evaluate Opportunities. Here's the chapter that addresses the specific mental framework the 1% apply to investment decisions, the analytical process they use to evaluate opportunities, filter out the attractive-sounding but mathematically unsound, and concentrate capital in the highest conviction opportunities available. The 1%'s investment decision framework is not primarily about having better information than other investors, though their professional networks provide better information access than most retail investors have. It is about applying a more rigorous analytical process to the information available, asking different questions than most investors ask, and being willing to say no to attractive-sounding opportunities that don't pass the framework's tests. The Expected Value Framework. Here's the core analytical tool that underlies every sophisticated investment decision: the expected value calculation that converts uncertain future outcomes into a single comparable metric for decision-making. Expected value is the sum of each possible outcome multiplied by its probability, the investment opportunity. With a 50% probability of 30% return and a 50% probability of 10% loss, has an expected value of 0.50 times 30% plus 0.50 times minus 10% equals 10% expected return. The investment opportunity with a 20% probability of 100% return and an 80% probability of 15% loss has an expected value of 0.20 times 100% plus 0.80 times minus 15% equals 8% expected return. The first opportunity has a higher expected value despite the much lower maximum return. The 1% apply expected value thinking, explicitly or intuitively, to every significant investment decision. They are not primarily interested in the best-case scenario of an investment. They are interested in the probability-weighted average of all scenarios, which is the specific calculation that most retail investors never complete, because the best-case scenario is so much more emotionally compelling than the probability-weighted average. The specific behavioral implication of expected value thinking. The 1% decline investments with spectacular best-case scenarios and poor probability-weighted expected values, the lottery ticket investment that could 100 times but is most likely to lose everything, in favor of investments with less spectacular best-case scenarios but better probability-weighted expected values. They are optimizing for the most likely good outcome rather than the least likely spectacular one. The Circle of Competence. The 1%'s first investment filter. Here's the first and most important filter in the 1%'s investment decision framework, the concept of the circle of competence, most explicitly articulated by Warren Buffett, that limits investment decisions to domains where the investor has genuine analytical advantage. The circle of competence is the specific set of industries, business models, and investment types where an investor has deep enough knowledge to evaluate opportunities more accurately than the market prices them. Within the circle, the investor has genuine insight into what an asset is worth and what the risks are. Outside the circle, the investor is relying on public information, management presentations, and intuition rather than genuine expertise, competing with specialists who have spent careers developing the specific knowledge that the non-specialist investor lacks. The 1% investment discipline is largely the discipline of staying within the circle of competence, concentrating investment capital in the domains where they have genuine analytical advantage and declining opportunities that are outside the circle, regardless of how attractive they appear. The attractive opportunity in an unfamiliar domain is declined not because the opportunity isn't attractive, but because the investor has no reliable basis for distinguishing genuinely attractive opportunities from appealing-looking bad ones in that domain. Warren Buffett has explicitly declined to invest in technology companies for most of his career, despite the extraordinary returns that many technology investments have produced, because he identified early that technology was outside his circle of competence. The discipline to decline spectacular-sounding opportunities outside the circle is the specific behavioral expression of the framework that produces Buffett's extraordinary long-term record. The application for non-billionaires, identifying and respecting the boundaries of your own competence, is the specific investment discipline that prevents the investment in the cryptocurrency project, the private equity deal, the angel investment, or the real estate opportunity that the sophisticated presenter made compelling, but that your own analysis was genuinely not equipped to evaluate. The most expensive investment mistakes are almost always made outside the investor's circle of competence. The 3-question filter. Here's the specific decision framework that the 1% apply to every significant investment opportunity. 3 questions that, when answered honestly, filter out the vast majority of investment ideas that the expected value analysis doesn't support. Question 1. What is the thesis, specifically? The investment thesis is the specific, falsifiable explanation of why this investment will produce above-average returns, not vague optimism about a sector or company, but a specific mechanism. This company generates 25% return on invested capital, is growing at 15% per year, and trades at a 12 times earnings multiple that undervalues the compounding of 25% ROIC at 15% growth. The inability to state the investment thesis specifically and falsifiably is the first indication that the investment is based on sentiment rather than analysis. Question 2. What are the specific ways this investment can fail, and what is the probability of each? The pre-mortem analysis, imagining that the investment has failed and identifying the cause, surfaces the specific risks that optimistic investment framing systematically obscures. The thesis might be wrong. The management might be dishonest. The competitive environment might change. The macroeconomic assumption might not hold. The regulatory environment might shift. Each specific failure mode has a probability, and the sum of those probabilities determines how much of the expected return is at risk from scenarios the thesis doesn't account for. Question 3. Why is this opportunity available? If the investment genuinely offers above-average risk-adjusted returns, the specific reason why, the specific information advantage, the specific structural reason the market has mispriced it, the specific investor behavior that has created the opportunity, needs to be identified. The investment opportunity that just seems undervalued without a specific explanation of why the market has mispriced it is not an identified opportunity. It is an unexamined assumption that the market is wrong and the investor is right, which is one of the most expensive assumptions in investing. The position sizing framework. How much to bet? Here's the specific analytical framework the 1% use to determine how much capital to allocate to each investment opportunity. The position sizing discipline that converts the investment selection framework into actual portfolio construction. The Kelly criterion, the mathematical formula for optimal bet sizing based on expected value and probability of success, is the theoretical foundation of position sizing, though its direct application is typically modified by the specific risk constraints and behavioral considerations of real-world investing. The practical position sizing rule that most 1% investors apply: the position size should be proportional to the investor's conviction in the investment thesis, which is itself proportional to the quality of the information advantage and the specificity of the thesis. High conviction positions with clear competitive advantages and defensible analyses might be 5% to 10% of the portfolio. Moderate conviction positions with good but not exceptional analysis might be 2% to 5%. Low conviction positions, interesting ideas that don't fully pass the 3-question filter, might be 0.5% to 2%. The behavioral implication of the position sizing framework, it prevents both the catastrophic concentration that results from putting too much capital in a single idea, however compelling, and the diversification dilution that results from spreading capital so thin across many positions that no individual position meaningfully affects portfolio performance. The framework concentrates capital in proportion to conviction while maintaining the diversification that prevents catastrophic loss. Chapter 9. The Mindset Architecture. The Psychological Operating System of the 1%. Here's the chapter that gets beneath the strategies, structures, and financial techniques to the specific psychological operating system that makes all of them work. The specific ways the 1% think about money, time, risk, failure, and wealth that produce the financial behaviors that their techniques then channel into specific outcomes. Because here's the foundational truth about the 1%'s money management. The techniques are learnable, the structures are replicable, the professionals are accessible in modified form, but none of them work if the underlying psychology doesn't support them. The person who understands the tax benefits of the SBLUC but can't resist drawing it down to fund lifestyle spending has learned the technique without developing the psychology. The person who understands the compounding math of index fund investing but sells during market declines has the knowledge without the behavioral infrastructure that makes the knowledge productive. The long time horizon as competitive advantage. Here's the specific psychological orientation that the 1% most consistently demonstrate and that most investors most consistently lack. The genuine, long time horizon orientation that converts the theoretically well understood benefits of patience and compounding into actually lived financial behavior. The long time horizon is not simply knowing that compound interest works over long periods. It is the specific, visceral, decision-influencing orientation toward distant future outcomes that makes present sacrifices feel genuinely worthwhile rather than theoretically advisable. The investor who genuinely experiences their 30-year future self as emotionally real and motivating makes genuinely different decisions than the investor who understands intellectually that long-term investing is beneficial, but experiences the sacrifice of present spending as the primary emotional reality of every investment decision. The 1%'s long-time horizon manifests in specific behaviors. They hold investments through market declines that would trigger selling in time horizon challenged investors. They make capital allocation decisions with 5-year and 10-year horizons rather than quarterly performance windows. They invest in professional relationships and skill development whose returns are years away. They structure business and estate planning with generational timelines rather than immediate return windows. Every behavioral manifestation of long-time horizon produces a financial advantage relative to the shorter horizon behavior it replaces. The specific practice that develops the long-time horizon, the explicit calculation and regular review of the financial independence number and the timeline to reach it. The investor who has calculated that their current portfolio, growing at 7% with current contributions, reaches financial independence in 11 years has a specific, concrete, emotionally accessible future that the vague aspiration to save more for retirement doesn't provide. The concreteness of the specific timeline makes the future self feel real in the specific way that produces present sacrifice-tolerating behavior. The asymmetric thinking pattern. Big upside, capped downside. Here's the specific cognitive pattern that the 1% apply consistently to opportunity evaluation. The systematic search for situations where the potential upside is large and the potential downside is limited and defined. The asymmetric payoff structure that produces better outcomes per unit of risk than symmetric or negatively asymmetric alternatives. The asymmetric thinking pattern rejects the implicit assumption that investment risk and return are symmetrically distributed around the expected value. The sophisticated investor looks specifically for opportunities where the distribution is positively skewed, where the worst-case scenario is a defined, manageable loss, and the best case scenario is a multiple times return. These opportunities exist because most investors avoid downside risk indiscriminately rather than sizing downside against upside, causing them to decline opportunities where a small defined downside is paired with a large, undetermined upside. The practical manifestations of asymmetric thinking, the startup investment where the maximum loss is the invested amount and the potential gain is multiples of the investment. The real estate purchase in a distressed market where the downside is limited by the income the property generates and the upside is the appreciation beyond distressed levels. The career risk that converts a stable but capped income trajectory into an uncertain but uncapped one. The skill investment that costs time and modest money and produces career optionality that is difficult to value but potentially extraordinary. The 1% systematically seek these asymmetric opportunities and systematically avoid the symmetric and negatively asymmetric ones. The investment where the potential gain is modest and the potential loss is large. The business risk where the downside is existential and the upside is incremental. The consistent application of asymmetric thinking produces a portfolio of decisions that generates better outcomes per unit of risk over time. The relationship between wealth and optionality. Here's the specific 1% perspective on what wealth actually is and what it is for. The philosophical foundation of their money management that produces the specific behaviors that build and preserve wealth rather than consuming it in the performance of having it. The 1% consistently describe wealth not primarily as consumption capacity, the ability to buy things, but as optionality, the ability to choose, the choice to work on what is genuinely interesting rather than what is financially required, the choice to take the career risk that the person without financial resources cannot take, the choice to help the family member who needs it without calculating the cost to lifestyle maintenance, the choice to say no to the business opportunity that is lucrative but ethically uncomfortable, the choice to wait for the right investment rather than deploying capital in a mediocre one. This optionality conception of wealth produces fundamentally different financial behaviors than the consumption conception. The person who views wealth as optionality does not convert every dollar of accumulated wealth into visible consumption, because visible consumption is not what wealth is for in this framework. Wealth is for choice. Visible consumption is the consumption of the choices that the wealth represents, producing the appearance of wealth while simultaneously reducing the actual wealth that generates the optionality. The specific investment implication. The 1% resist converting liquid, flexible investment assets into illiquid, inflexible consumption even when the consumption is financially possible. They maintain the portfolio of choices rather than selecting the most visible choice. This resistance to consumption conversion is the specific behavioral expression of the optionality conception of wealth, and it is what produces the continued accumulation that preserves the optionality indefinitely rather than consuming it temporarily. The failure tolerance. Treating loss as information. Here's the psychological orientation toward failure and financial loss that most dramatically distinguishes the 1%'s relationship with risk from the typical investors, the specific treatment of investment losses and business failures as information inputs rather than identity threats. The psychological research on loss aversion, the specific finding that losses produce approximately twice the emotional impact of equivalent gains, explains the specific behavioral pattern that most damages investment returns, the selling of losing investments to eliminate the psychological pain of the loss, and the holding of losing positions past rational stopping points to avoid the psychological pain of converting a paper loss to a realized one. The 1% have a relationship with financial loss that is more informational and less identity-threatening than the typical investors, not because they feel losses less intensely, but because they have developed the specific cognitive framework that treats losses as information about what didn't work, rather than as evidence about their fundamental competence or worth. The investment that lost money provides specific information about the investment thesis that was wrong, the risk that was underestimated, or the market dynamic that was misunderstood, all of which is valuable input to the next decision. This informational treatment of failure produces the specific behavioral pattern that enables the 1%'s continued risk-taking, the willingness to make the next investment, the next business decision, the next career risk, without the specific paralyzing effect that identity-threatening loss experiences produce. The venture capitalist who has funded 15 investments and watched 10 of them fail is not paralyzed by the 10 failures. They are informed by them in ways that improve the next 5 investments. The loss tolerance is not insensitivity. It is the specific reframing of loss as the tuition of competence development rather than the evidence of fundamental inadequacy. Chapter 10. The Spending Philosophy. How the 1% actually spend their money. Here's the chapter that addresses what might be the most surprising dimension of 1% money management, the specific ways they actually spend their accumulated wealth, because the popular image of 1% spending, the private jets, the super yachts, the multiple luxury properties, the conspicuous consumption of resources that most people will never have, is simultaneously real for a fraction of the ultra-wealthy and dramatically unrepresentative of the spending philosophy that most of the 1% actually practice. The spending philosophy of the 1% who have built and maintained genuine wealth, as opposed to the spending philosophy of the 1% who have recently experienced a windfall and are discovering what $50 million buys, is specific, deliberate, and significantly more modest in the visible consumption categories than the popular imagination suggests. The ROI framework applied to spending. Here's the specific analytical framework the 1% apply to spending decisions that most people never apply to any spending decision. The return on investment analysis extended from investment decisions to consumption decisions. The ROI framework for spending asks, what specific value does this expenditure produce, measured in terms that matter to the spender? Health, time, relationship quality, genuine enjoyment, professional effectiveness? And is that value proportional to the cost relative to alternatives? The 1% spending that passes this analysis easily, the health investment, personal training, quality nutrition, preventive medical care, sleep, optimization, that produces the cognitive and physical performance that sustains their professional effectiveness and longevity. The time purchase, the cleaning service, the personal assistant, the meal preparation, that frees hours for the highest value professional and personal activities. The professional development, the educational program, the coaching relationship, the conference attendance, that expands the competence and the network that produces professional income and opportunity, the relationship investment, the memorable experiences with the people who matter most, that builds and maintains the relationships that are both intrinsically valuable and professionally generative. The spending that fails the ROI analysis, the status consumption that produces primarily social signal rather than genuine personal value. The luxury upgrade that costs a significant premium relative to the functional equivalent for marginal improvement in actual experience. The visible wealth performance for audiences whose opinion of the spender's financial status has no bearing on the spender's actual financial outcomes. The time purchase, the 1%'s most consistent spending priority. Here's the specific spending category that the 1% most consistently prioritize regardless of the other spending choices they make. The purchase of time and attention by eliminating or outsourcing activities that consume time without producing proportional value. The premise of the time purchase is the specific recognition that at the income and wealth levels the 1% operate at, the value of their time, measured in the productive value generated per hour of focused effort, is very high. The hour spent on administrative tasks that a competent assistant could handle for $25 is an hour not spent on the highest value professional or personal activity. The specific cost of the administrative task is not $25. It is the value of what the hour would have produced if spent differently. The specific time purchases the 1% most consistently make. The personal assistant who manages scheduling, administrative correspondence, logistics, and the 100 small tasks that consume executive attention without requiring executive capability. The household management services, cleaning, property maintenance, personal errands, that consume time without producing the enjoyment or relationship value that would justify the personal time investment. The concierge services, travel planning, reservation management, healthcare coordination, that eliminate the transaction cost of coordinating complex logistics. The professional services, accounting, legal, investment management. That could technically be self-performed, but that would consume time at a cost that exceeds the professional's fee relative to the alternative use of that time. The accessible version, the ROI analysis of time purchases, is applicable at income levels far below the 1%. The household earning $100,000 per year, where each partner's effective hourly rate is approximately $25 to $35 per hour of work time, finds that many outsourced services are financially rational at their actual cost. The cleaning service at $150 bi-weekly that frees 4 hours per partner is the purchase of 8 hours of time for $150, a rate of $18.75 per hour below both partners' effective hourly rate. The financial case for time purchases scales with income but is positive at income levels most people don't associate with the luxury of outsourcing household tasks. The experience over possession orientation. Here's the spending philosophy that the research on happiness and consumption most consistently validates and that the 1% most consistently practice: the deliberate prioritization of experiences over possessions as the primary vehicle for spending-derived satisfaction. The hedonic adaptation research, the documented finding that the satisfaction derived from acquired possessions decays rapidly as the novelty wears off and the possession becomes part of the new baseline, explains why consumption spending produces systematically less sustained happiness than anticipated. The car that produced excitement for 3 months becomes transportation. The house that produced pride for 6 months becomes the place you live. The watch that produced satisfaction for a year becomes the thing on your wrist. Experiences don't adapt in the same way. The memory of a remarkable trip, a meaningful dinner, a genuinely engaged conversation remains satisfying long after the experience has ended, because the memory is not subject to the hedonic adaptation that makes physical possession lose its novelty. The 1%'s consistent spending preference for experiences, the travel, the cultural engagement, the education, the social connection, over comparable cost possessions, reflects the specific ROI calculation that experiences produce more sustained value per dollar than possessions. The accessible application, the consumption decision that redirects spending from the status signaling possession to the genuine experience, is simultaneously more satisfying and often less expensive. The remarkable dinner at the excellent restaurant is both more memorable and less expensive than the watch that produces 3 months of satisfaction before becoming background. The charitable spending strategy, generosity as a financial practice. Here's the spending dimension that connects the 1%'s financial management to their broader value system, the specific role of charitable giving in the financial architecture, which serves simultaneously as genuine generosity, tax management, community investment, and legacy construction. The 1% gives significantly more to charity than the general population, both in absolute terms and as a percentage of income. The average charitable giving of high net worth households is significantly higher than the population average, with many wealthy families targeting 10% to 20% of annual income for charitable purposes rather than the 2% to 3% that represents the typical household's giving rate. This generosity is not primarily tax motivated. The tax benefits of charitable giving are real, but secondary to the genuine philanthropic intent of most high net worth givers. But the tax benefits are real and worth understanding. The charitable deduction for contributions of appreciated assets described in Chapter 2 produces the specific outcome where donating appreciated stock to a donor-advised fund generates both a full fair market value deduction and elimination of the capital gains tax that selling would have produced. The practical framework for accessible charitable giving that incorporates the tax benefit: establish a donor-advised fund at any major brokerage, Vanguard Charitable, Fidelity Charitable, Schwab Charitable, with a minimum contribution of $5,000. Contribute appreciated assets rather than cash whenever possible, maximizing the tax benefit of the contribution. Direct the DAF to make grants to chosen charitable organizations on whatever schedule is appropriate. The DAF allows the immediate tax deduction to be captured in a high-income year, while the actual charitable grants are distributed to organizations over multiple years. Chapter 11. The Network Architecture: How the 1% Build and Leverage Relationships. Here's the chapter that addresses the specific role of professional and social relationships in the 1%'s financial success, a role that is simultaneously more significant than most financial content acknowledges and more specific in its mechanics than the generic network is net worth advice that gets repeated without the operational detail that makes it actionable. The 1%'s relationship architecture is not primarily about knowing impressive people or having access to exclusive social environments. It is about the specific construction and maintenance of relationships that provide the information advantages, the deal flow, the talent access, and the collaborative opportunities that produce superior investment and business outcomes relative to what isolated decision-making produces. The information network, the 1%'s actual research advantage. Here's the most financially significant function of the 1%'s professional network: the specific information advantage that relationships with genuine domain experts provide over the public information that retail investors rely on. The information advantage in investing is not insider trading, the illegal use of material non-public information about specific companies. It is the legitimate legal advantage of having accumulated relationships with people who have deep expertise in specific industries, specific markets, and specific business models, and who provide context, pattern recognition, and judgment that is not available in public filings, analyst reports, or financial news. The private equity fund manager who has invested in 20 healthcare technology companies has developed genuine expertise in the healthcare technology market. The specific regulatory dynamics, the competitive landscape, the customer adoption patterns, the management team characteristics that distinguish successful from unsuccessful companies. This expertise, accumulated over a career of deep industry investment, produces investment judgments that a generalist investor reading the same public information cannot replicate, not because the private equity manager has better access to information, but because they have the pattern recognition that converts information into insight. The 1%'s network provides access to this expertise on demand, the phone call to the domain expert who has seen the specific situation before, the conversation with the industry veteran who can contextualize the specific investment opportunity, the introduction to the management team whose previous company the network contact invested in 10 years ago. These conversations convert public information into specific insight that produces better investment decisions than the same public information processed without domain expertise. The deal flow network, the opportunity access that relationships provide. Here's the second specific financial function of the 1%'s professional network: the deal flow access that relationships provide to investment opportunities that are not available through public channels. The most attractive investment opportunities in private equity, venture capital, and real estate are not distributed publicly through investment banking processes or real estate listings. They are distributed privately through networks of trusted relationships, the limited partnership opportunity offered first to the existing LP who has been a good partner, the off-market real estate transaction presented to the buyer who has closed previous deals without complications, the startup round offered first to the angel investor who has been helpful beyond the capital they provided. Access to these off-market network-distributed opportunities requires the established relationship infrastructure that generates the introduction rather than the cold approach. The investor who has no existing relationships in private equity receives no LP interest allocation in a closed, oversubscribed fund. The investor who has a relationship with the general partner, through a previous investment, a shared professional history, or an introduction from a trusted mutual contact, receives the call when an allocation becomes available. Building the network that generates deal flow is a specific, long-term investment in relationship development. The years of providing genuine value to the professional community, of developing the reputation that makes introductions reliable, of maintaining the relationships that generate the reciprocal information and opportunity flow that network theory predicts. It is not accomplished through aggressive networking at industry events. It is accomplished through the sustained, genuine investment in relationships with people whose judgment and character you respect and whose interests you have genuinely served. The talent network, how the 1% find the people who build their wealth. Here's the third specific financial function of the 1%'s professional network: the access to exceptional talent that relationship-rich networks provide for the businesses and investment opportunities the 1% are building. The most valuable resource in any business or investment is genuinely exceptional talent, the operator who builds the company, the investment professional who allocates capital skillfully, the legal and financial professionals who structure transactions correctly. The difference between the good version and the exceptional version of these roles is not marginal. It is the specific difference that produces the top quartile private equity fund versus the average one, the fast-growing portfolio company versus the one that plateaus, the successfully structured transaction versus the one with unforeseen liabilities. Access to exceptional talent requires the network that services exceptional people before they are publicly available, the executive who is open to the right opportunity but not actively job searching, the investment professional who would leave their current firm for the right partnership, the operator who has the specific skills for the specific business but has never crossed the path of the business owner who needs those skills through conventional hiring channels. The 1%'s talent network is the specific mechanism that provides this access, the relationship with the executive search professional who knows which senior executives are quietly open to conversations, the business school connection who knows which recent graduates are the exceptional ones worth recruiting, the industry contact who knows which portfolio company operators are available and excellent. Chapter 12. The Implementation Roadmap. How to actually apply 1% principles starting now. Here's the chapter that assembles the full framework of the previous 11 chapters into a specific, actionable, sequenced implementation plan that applies the 1%'s money management principles to the financial life of someone who is not yet in the 1% same, organized by the specific actions that produce the highest return per unit of effort at each financial stage. The implementation is not a single transformation that happens all at once. It is a staged development, specific actions appropriate to each stage of financial development, building the infrastructure of the 1%'s money management progressively as the financial position grows to support each component. Stage 1, the foundation, net worth, under $100,000. Here's the specific implementation priority for the financial life that is in its early accumulation phase, the actions that produce the most significant improvement in financial trajectory at this stage. Action 1. Eliminate all high-interest consumer debt. The cost of capital analysis from Chapter 4 makes this the highest return financial action available at this stage. The guaranteed return of eliminating 20% plus interest debt exceeds any investment alternative. The debt avalanche, minimum payments on all debts while directing all additional payment capacity to the highest interest debt, is the specific execution framework. Action 2. Capture the full employer 401k match. The immediate 50% to 100% return on matched dollars is the second highest return action available, and it requires only the administrative action of adjusting the payroll contribution percentage to the match threshold. Action 3. Open and begin funding a Roth IRA. The tax-free compounding and tax-free withdrawal characteristics of the Roth IRA make it the most valuable account type for most Stage 1 investors, and the investment should be in the simplest, lowest cost, most tax-efficient vehicle available. Total Market Index Funds. Action 4. Build the basic professional team. At this stage, the professional team is modest. A fee-only financial planner for an annual or semi-annual planning review, and a CPA with tax planning orientation for the annual tax return and quarterly estimated payment planning. The investment in professional guidance at this stage prevents the specific tax and planning mistakes that are expensive to correct later. Action 5. Establish the basic insurance foundation, term life insurance sufficient to replace income for dependent family members, disability income insurance that supplements the employer-provided coverage, umbrella liability insurance at $1 million or more above homeowners and auto policy limits. Stage 2, the acceleration net worth $100,000 to $1 million. Here's the specific implementation for the wealth accumulation phase where compound growth is beginning to become a meaningful contributor to portfolio growth. The actions that accelerate the trajectory and add the alternative asset exposure that begins to differentiate the 1%'s allocation from the conventional retail portfolio. Action 1. Maximize all tax-advantaged accounts. the 401k to the annual maximum, the Roth IRA to the annual maximum, the HSA to the annual maximum if eligible. The tax optimization from complete utilization of available tax-advantaged space produces meaningful after-tax return improvement relative to equivalent taxable investment. Action 2. Add real estate exposure. At the $300,000 to $500,000 net worth level, the first rental property purchase becomes financially accessible. The down payment is available, the financial stability to absorb unexpected costs is established, and the leverage returns of real estate investment begin to meaningfully differentiate the portfolio from a pure public equity allocation. Action 3. Establish the business entity structure. If self-employed income is any part of the income picture, the entity structure, S corporation, LLC, or corporation depending on the specific situation, should be evaluated with the CPA and established if beneficial. The S corporation salary versus distribution optimization and the QBI deduction are both accessible at income levels below the 1%. Action 4. Expand the professional team. Add the estate planning attorney for the basic estate planning documents. Will, revocable living trust, powers of attorney, beneficiary designation review. Add the independent insurance broker for the full insurance portfolio assessment as the asset base grows to levels where additional coverage is warranted. Action 5. Begin building the professional network deliberately, the relationship investment that produces the deal flow. Information and talent access described in Chapter 11 is a long-term development that produces its greatest returns years after it begins. The professional community engagement, the genuine value provision to professional contacts, and the deliberate cultivation of relationships with people further along the financial development path all begin in this stage. Stage 3. The optimization. Net worth $1 million to $10 million. Here's the implementation for the wealth level where the 1% strategies become most directly applicable, where the portfolio is large enough to access meaningful alternative investments, where tax planning produces significant absolute dollar savings, and where the estate planning infrastructure becomes genuinely important. Action 1. Add alternative investment exposure. The semi-liquid alternatives, interval funds, non-traded REITs, BDCs, that provide private market exposure at minimums of $10,000 to $50,000 are appropriate to introduce at this stage. The allocation should follow the endowment model principle, 20% to 30% in alternatives, with the public equity and fixed income allocation reduced proportionally. Action 2. Implement the buy, borrow, die strategy on appropriate positions. The appreciated investment positions that have grown to significant size should be evaluated for the S-block strategy, the ability to access the appreciation through borrowing rather than selling, deferring the capital gains tax indefinitely. The S-block is established with the brokerage, the credit line is sized conservatively, and the borrowing discipline of not exceeding 30% of pledged value is maintained. Action 3. Implement the charitable giving strategy. The donor advised fund is established and funded with appreciated assets in high-income years, capturing the full deduction and eliminating the capital gains tax. The charitable giving strategy is coordinated with the tax planning to maximize the aggregate tax benefit in years of elevated income. Action 4. Implement the advanced estate planning structures. The GRAT for highly appreciated positions, the ILIT for the life insurance estate liquidity strategy, the family limited partnership for real estate or business interests that benefit from the valuation discount. Each of these structures should be evaluated and implemented where appropriate with the estate planning attorney and the tax advisor working in coordination. Action 5. Evaluate the family office equivalent. At the upper end of this stage, the single family office becomes financially accessible for the wealthiest households. The multifamily office that provides coordinated professional services to multiple families is accessible at lower minimums. The coordination of investment, tax, legal, and insurance strategy through a unified professional team produces the integration benefit that produces outcomes better than the sum of individually optimal professional advice. The daily practices that implement everything. Here's the specific daily and weekly practice structure that converts the 1%'s philosophical principles into lived financial behavior. the specific routines that the infrastructure above operates within. The weekly financial review, 15 minutes reviewing the cash flow, investment account values, and any financial decisions requiring attention. The purpose is not anxiety-driven monitoring, but the specific awareness maintenance that prevents financial drift and maintains the deliberate intention that the 1%'s money management requires. The monthly professional team communication, a brief update to the financial planner on any significant changes in income, spending, or financial situation. The purpose is maintaining the advisor's current awareness so that the proactive identification of opportunities and vulnerabilities that the coordinated team provides can operate on current information. The quarterly investment review, the structured review of portfolio performance, allocation drift, and any rebalancing required to maintain the target allocation. The review is conducted against the written investment policy statement, the document that specifies the investment strategy, the allocation targets, and the decision framework, not against current market sentiment. The annual comprehensive review, the full financial picture, tax return review with the CPA, investment strategy review with the financial planner, insurance coverage review with the independent broker, estate plan review with the attorney, and personal financial goals review that updates the plan for the changes in the personal situation since the previous annual review. Chapter 13. The mistakes the 1% never make twice. Here's the final chapter, approached from the opposite direction of everything that came before it. Every previous chapter described what the 1% do. This one describes what they don't do, the specific financial mistakes that, once made, are almost never repeated by people who build genuine wealth, and that are made continuously in every generation by people who don't. The mistakes are not obscure. They're immediately recognizable, not as things you haven't heard of, but as things you know you shouldn't do and may have done anyway. The 1%'s advantage here is not superior knowledge about which behaviors are financially damaging. It's the specific combination of experience, accountability structures, and professional relationships that make the damaging behaviors harder to execute and the beneficial ones automatic. Confusing income with wealth. The most expensive mistake, and the one most consistently made by high earners, is treating high current income as equivalent to financial security. The professional earning $400,000 per year who spends $400,000 per year has zero wealth regardless of how impressive the income looks from the outside. The income stops, the obligations continue, and the financial position is identical to someone earning $40,000 with the same savings rate of zero. The 1% have learned, either through direct experience of income disruption or through watching it happen to others, that income is a flow and wealth is a stock. The flow only produces the stock when it isn't entirely consumed by the lifestyle it funds. The behavioral fix is simple and non-negotiable. Savings rate is decided before lifestyle is designed. The percentage that accumulates is chosen first. The lifestyle is built from what remains, not the other way around. Letting lifestyle inflation consume every income increase. Here's the mistake that prevents wealth accumulation at every income level: the automatic conversion of every income increase into a proportional lifestyle increase that leaves the gap between income and spending permanently unchanged regardless of how much income grows. The $30,000 raise that becomes the upgraded apartment, the newer car, and the more expensive social life within 6 months has been entirely consumed. The wealth trajectory has not improved despite significant income growth. The 1% who stop making this mistake apply a predetermined protocol. A minimum of 50% of every income increase goes directly to investment before the lifestyle adapts to expect it. The automatic increase in the investment contribution happens on the day the raise takes effect. The lifestyle adjusts only to the remainder. Hiring the wrong professionals. The commission-based financial advisor who recommends the highest commission product. The insurance agent who sells the most expensive policy the client will accept. The accountant who files accurately but never identifies a planning opportunity. Each of these professionals provides the service they are financially incentivized to provide, which is not necessarily the service the client needs. The 1% learn, usually through an expensive lesson, to pay the transparent fee that genuine alignment requires, rather than accepting the apparent free advice that commission compensation disguises. The fee-only fiduciary planner who charges $10,000 annually and identifies $40,000 in tax savings is cheaper than the advisor who charges nothing explicitly and recommends nothing that costs them commission income. Professional guidance is not an expense. It is an investment with a calculable return. Waiting for perfect conditions. The market is too high, too volatile. The economy is uncertain. The debt should be cleared first. The knowledge isn't complete enough. There is always a specific, legitimate-sounding reason why now is the slightly wrong time to invest and soon will be better. The 1% have learned that perfect conditions never arrive, and that the cost of waiting for them is specific, compounding, and permanent. The fix is automation. The automatic investment on a predetermined schedule removes the decision, and therefore removes the opportunity for the perfect conditions justification to delay it. The investment becomes the default that requires specific action to override, rather than the choice that requires specific motivation to execute. The meta lesson: here's what ties every mistake on this list together. The single observation that the 1%'s mistake avoidance consistently reflects, and that the people who keep making mistakes consistently miss. Every mistake on this list is made in the presence of complete knowledge that it is a mistake. The knowledge is present. The behavior doesn't follow. The gap between financial knowledge and financial behavior is not closed by more knowledge. It is closed by structures. The automatic investment that prevents the perfect conditions mistake, the predetermined savings rate that prevents the lifestyle inflation mistake, the fee-only professional relationship that prevents the wrong advisor mistake, the investment policy statement that prevents the emotional selling mistake. The 1%'s money management is not primarily a knowledge advantage. It is a structural advantage. The structures make the right behavior the default and make the wrong behavior require deliberate effort to execute. That is the final lesson of this entire video, not what to know, what to build. Build the structures. The knowledge will find its expression through them, and the mistakes, the expensive, avoidable, endlessly repeated mistakes that have cost more accumulated wealth than any market crash, will stop being made. Not because you've finally learned them well enough, because the structures make them impossible by default. That's how the 1% do it. Now you know how too. Conclusion. Here's the honest assessment of everything this video has covered and what it actually means for the person who has watched all of it. The 1%'s money management is not magic. It is not primarily luck. It is not exclusively the product of circumstances that most people don't have access to. It is a specific, coherent, learnable system of financial principles that produces specific financial outcomes when applied consistently, and that produces those outcomes at every wealth level where the principles are applied, not only at the wealth levels where the most sophisticated implementations are accessible. The foundational principles, the asset allocation that reaches beyond public markets, the tax architecture that favors capital gains over ordinary income, the professional team that coordinates rather than fragments financial decisions, the debt philosophy that distinguishes investment debt from consumer debt, the estate planning infrastructure that preserves accumulated wealth across generations, the risk management that protects what has been built, the income architecture that diversifies beyond single-stream employment, the investment decision framework that applies expected value thinking rather than narrative optimism, the psychological operating system that treats wealth as optionality rather than consumption capacity, the spending philosophy that prioritizes ROI and genuine value over social signal, and the network architecture that generates information and opportunity advantages are all accessible in modified form at wealth levels far below the 1%. The modifications are real. The donor-advised fund that the Stage 2 investor opens with $10,000 is not the family foundation that a billionaire operates. The revocable living trust that the Stage 2 investor establishes is not the dynasty trust that a $100 million family deploys. The independent fee-only financial planner that the Stage 1 investor retains is not the family office chief investment officer. The modifications are meaningful, but the principles they implement are identical. The tax efficiency of giving appreciated assets rather than cash is the same principle whether the gift is $10,000 or $10 million. The estate planning benefit of having a coordinated legal structure rather than no structure is the same principle whether the estate is $500,000 or $500 million. The investment advantage of applying expected value thinking rather than narrative optimism to investment decisions is the same principle whether the portfolio is $50,000 or $50 billion. Here's the most honest final thing this video can say. The gap between how the 1% manage their money and how most people manage their money is not primarily a gap in available strategies, accessible vehicles, or acquirable professional support. It is primarily a gap in awareness and deliberateness. The 1% manage their money deliberately, with specific professional support, specific analytical frameworks, specific legal and tax structures, specific allocation philosophies, and specific behavioral disciplines, while most people manage their money reactively, without professional integration, without analytical frameworks, and without the structural choices that convert earned income into lasting accumulated wealth. The awareness gap is what this video has addressed. The deliberateness gap is what implementation produces. The strategies are clear, the structures are accessible, the professionals are findable, the behavioral disciplines are developable. The gap between knowing and doing is the only remaining gap, and that one belongs entirely to you.